What is the standard deduction for married couples? Have you ever wondered how the standard deduction can impact your taxes as a married couple? Understanding this can make a big difference in your tax planning. Let's break it down. For the year 2025, the standard deduction for married couples filing jointly is $30,000. This amount is an increase from $29,000 to $100 in 2024. This deduction reduces your taxable income automatically, which simplifies the tax process for couples who do not choose to itemize their deductions. If you are married but filing separately, the standard deduction is $15,000 for each spouse, which is the same as the deduction for single filers. Surviving spouses who qualify as a qualifying widow or widower can also use the $30,000 amount for joint filers. Now, how does this affect your tax calculations? The standard deduction lowers your taxable income before applying the tax rates. For example, if a married couple earns $100,000 in 2025, they would subtract $30,000 from their income. This leaves $70,000 as their taxable income. By doing this, they reduce their tax liability because a portion of their income is not subject to taxation. There are also additional deductions for specific situations. If either spouse is 65 years or older or blind, they can claim an extra standard deduction. In 2025, joint filers in these categories can receive an additional $1,600 for each qualifying condition. So, if both spouses are 65 and blind, they could claim a total of $3,200 extra. When considering your options, it is important to weigh itemizing versus taking the standard deduction. Couples should compare their potential itemized deductions, like mortgage interest or charitable contributions, against the $30,000 standard deduction. If the total of itemized deductions is less than $30,000, the standard deduction is usually the better choice. The value of the deduction also depends on your tax bracket. For instance, if a couple falls into the 24% tax bracket, the $30,000 deduction could save them $7,200 in taxes. In some cases, married couples filing separately might find it beneficial to take the $15,000 deduction each if one spouse has significant itemized expenses. However, this situation is rare due to restrictions on certain deductions, like student loan interest. Understanding terms like standard deduction, qualifying widow or widower, and marginal tax rate can also help in your tax planning. The standard deduction is a fixed dollar amount that reduces taxable income and is adjusted annually for inflation. A qualifying widow or widower is a filing status that allows surviving spouses to use joint filer rates and deductions for 2 years after their spouse's death. The marginal tax rate is the rate applied to the last dollar of taxable income, which helps determine the actual savings from deductions. For most couples, the standard deduction simplifies tax filing while providing substantial savings. However, those with high mortgage debt, medical expenses exceeding 7.5% of adjusted gross income, or large charitable gifts should evaluate itemizing their deductions each year. Tax professionals often suggest reviewing deduction strategies every 2 years to align with life changes, such as buying a home or retiring. Understanding the standard deduction can help you make informed decisions about your taxes and maximize your savings.